Welcome. You're watching Talking Point. I'm Tamanna Inamdar. We're at a very interesting time in the Indian markets. We're making new highs every day, technically, as per the numbers. But are we seeing that same frenzy, confidence to sustain that level of growth? A couple of factors there need to be very clear to turn the tide. Questions that we're trying to address today with our guest on the show. Does the growth potential in the broader markets and small and mid-cap companies continue despite the kind of run-up in valuations? What about the role of FPIs? FPIs have been selling at least for the first couple of months of 2024. When does that pivot turn? Is it going to be after Fed cuts rate? Is there going to be a wait for China to improve? Or are we going to wait for the election season to end, at least in India? We're going to talk a bit about IT companies and financials as well. So an interesting chat lined up. And to answer some of these questions today is Vinod Karki, Senior VP of Equity Research, ICICI Securities. Vinod, hi. Welcome to Talking Point, and great to have you on the show. Let's begin by getting your take on where we are. So we've ended a fairly successful Q3 season, one would say, though there are divergent views on that. I'd like to know what you think. What, in your view, is the next big trigger?
Thanks, Tamanna. So, yeah, if you just see where we are, so if you just roll back where we started the year, we were close to this level, 21,800 on the Nifty, I guess, around December, Jan. And we are around 22, so it's just a couple of percentage points here and there. But you have to look at the market in two contexts. One is the valuation and the other is the growth. So there is no denying that on valuations, things are expensive. But equally important is that there is no denying that after a long time, we're seeing the profit cycle continue to grow at a sustained pace. So if you just see the overall profitability in the system, corporate system, we were in FY23, we were at around 4.3% of GDP. And on a trailing 12-month basis after these Q3 results, we are at 4.9. So all said and done, the corporate profits are growing at a rate faster than nominal GDP. There's no question about that. And if I look at any forecasts of key indices like Nifty and the other smaller mid-cap indices, it's anywhere between close to around 20% odd. That's the forecast I'm getting from 23-25 perspective. While we know that the nominal GDP will be growing around 10-12% kind of thing. So this faster than nominal GDP expansion of profit cycle is continuing. But as we know, the valuations are at the higher end, which typically happens when growth is at a faster clip. So that's how we are currently right now, that growth is quite robust, but valuations are not leaving much on the table right now for investors.
I want to speak specifically about growth, and then we'll come to valuations, because you have a very strong and fair and clear point that valuations are not leaving much on the table. But when you're talking about earnings, and your report on Q3 says that as far as small caps are concerned, the maximum upside in PAT to GDP left within small caps is at 0.7% versus cycle peak of 1.2%. I want to get your sense on whether some of these earnings really stood the test of valuations. Because the run-up and anticipation when it came to the actual numbers in corporate earnings, did you see spots of disappointment there?
I think earnings, when I see the beats and misses, it was even Steven kind of thing. There was some misses in mid-cap, but small caps was reasonably good, large cap was reasonably good. But what I made a point over there is, if you have to believe in a cyclical recovery in the economy driven by the investment rate, CapEx cycle, real estate cycle, which typically benefits the smaller companies a lot because they get a good amount of ordering in terms of these capital-intensive sectors. We have seen that the previous profit cycle, which peaked out in 2008 at a peak of around 6 to 7% of GDP, if I see where we are right now and where the maximum, what I should say, if you have to believe in a cycle that things peak out at a certain point in time, the maximum upside left is still in small caps because they have been affected a lot over the last several years. Several crises have been there, and they are coming out of this bad situation. And in terms of where they are and where they can go, there is a lot of steam left in terms of purely on a cyclical basis, where capital sector, the whole capex cycle, real estate cycle is picking up, which typically tends to benefit these smaller companies. So yeah, so I think the growth is there. It shows up in the estimates also when I look at the Nifty mid cap or the small cap estimates. I mean, the growth is in 20s as compared to 17-18% estimated growth for the Nifty 50. So there is this element of higher growth. On trailing basis as well as on expectation basis, and on a cyclical basis, it seems that there is steam left in terms of earnings growth for this space.
Earnings growth, yes, but then let's come to the second part of what you said in terms of valuations and how much of that value is actually left on the table. So I was having a conversation yesterday, and there was an interesting quote that came up to describe the markets right now, which is, it's a bit like you come late to the party and the best food and drink is over, and then you're sort of rifling through the leftovers to see what you can find. Do you get that sense, or are there enough spots of fairly valued companies still there, or you just have to now live with the current valuations and expect earnings to catch up?
I think it's of the latter, that you have to live with these higher valuations, because when I look at my framework of relative valuation of small and mid caps over large caps, it is at a most unattractive zone from a cyclical perspective. So there is no margin of safety in small cap, mid cap. There is no question about that. They are in fact clearly trading above large caps. But as I said, if you see past instances where such situation happened after the first Modi election victory in 2014, and mid-cap, small-cap indices went up within a matter of few months, 70-80%. I mean, indices, I'm not talking about stocks, and they became expensive compared to large cap. And what we saw is that after 2018 was when, after 4 years, that bubble bust. So these higher valuations can remain longer, several years, in fact, if the growth continues to support it. So that's the point. I mean, in fact, this time around, the growth is more supportive than it was earlier, because earlier in 2014 to 18, I don't think there was an investment boom or a real estate cycle boom. In fact, it was fading. But this time it's rising. So that's something on their side. But there's no margin of safety where you can have very high alpha from this space. But you can't say they're going to collapse. They may tag along, do kind of nifty, the large cap kind of returns. That's possible.
Yeah. So, I mean, anyone who has been waiting for that correction for the last many months is, I suppose, still waiting. You mentioned the real estate cycle turn, and you've said it a couple of times. So I must ask you, Vinod, do you think that there are still fairly valued companies in that space which have not run ahead of expectations? Because if you look at broadly, the earnings were fine, but in some cases there were some disappointments in terms of scale of execution, in terms of cost of inputs. These are things that real estate players are also struggling with. Anything that you like or an outlook you have on this space in the listed category?
Yes. So real estate cycle for sure is, we just entered, I think, the second year into this cycle. So typically they can last 5 to 6 years or even higher, depending on the structural strength. But the stocks, I think, are mostly, if I look at our coverage universe, are mostly priced to perfection. I don't think there's a huge upside there, any big upside left. But the way to play real estate is, I think, through the supporting companies. For example, if you look at banks, which will be lending to the real estate mortgage cycle. So if you're saying that there's going to be a big real estate cycle, obviously mortgage lending will be a good sector, and you have a lot of financial companies here and large companies which are at very reasonable valuations. So and building material companies, where there have been some of them at least are in our coverage universe are reasonably valued. So I think you have to play more indirectly in the real estate cycle through lenders and the guys who build out these real estate projects, which are available at reasonable valuations.
Yeah. Vinod, keen to know your view on private banks as well. Definitely one space left out, definitely in the large cap space. And I think one highlight, if there were 2 or 3 headlines from the results season, it was IT companies didn't do as badly as was expected, and private banks did worse than was expected, HDFC Bank being on top of that heap. Now you're seeing a bit of a sentiment turnaround. Would it be fair to say that the next leg of the rally is coming from private banks and the large ones at that?
From a cycle perspective, I'm extremely confident of the banking sector as such, especially large caps, and within that, relatively the private banks, if you see their long-term valuation, they are at reasonable valuation. So from a cycle perspective, when I say cycle, if you look at the NPA cycle, we're still bottoming out on the NPA cycle. You've not yet formed the bottom. RBI says in FY24, we'll be forming a bottom of the NPA cycle. Whereas the CapEx cycle is just about picking up. So in the previous cycle, if you see between 2003 to 2008, it was largely the corporate lending cycle, the releveraging in the corporate sector, which led to huge gains in growth for banks. So that's yet not picked up. We are sub double-digit growth in that space, while retail is what is driving whatever growth is there. So I think a combination of where we are in the cycle, both on valuations and growth trajectory, NPA cycle, I'm extremely confident on banking as such, especially, I mean, some of these quality large cap banks, so I think that's a good space to be. I mean, where if you see
public,
the rest of the market,
private or public?
Public, private, both.
Okay,
both.
Okay, because PSBs are the ones in favor. Not so much as private banks, but you're saying both will come in.
So both. I mean, both. Which I mean, I would prefer the larger banks because they have. We can expect that they have the wherewithal to really absorb the growth in a big cycle, and wherever there has been, they have shown the ability to underwrite in a prudent way. Because the biggest risk with banks is the underwriting issue. Basically, can they keep NPAs limited when the cycle turns? Because growth anyways will come. The credit growth will come up. We have seen in the past cycle that when the credit growth really picked up due to the releveraging cycle, credit growth was almost 2 times of nominal GDP. So one cannot say that this will not happen again. There may be a time over the next 2, 3, 4 years where credit growth might be much higher than nominal GDP, given the way the economy is progressing and we're getting GDP upgrades. There is no way a country can expand investments and capex and overall productivity without getting bank credit to participate. So that's going to happen for sure.
Vinod, it would be amiss if we didn't talk about the possibility of a pre-election rally. Now, the question over here gets a little complicated because a continuity of the same government has been priced in. You saw that big bump up late last year. Do you think that this has, in a sense, become a non-event, or are you expecting a bit of a pre-election rally like we have been seeing consistently over the last, I would say, 5 or 6 general elections 3 months before the event?
I think we are already in that mode where the market is getting excited that we're going to have a clean mandate, a clear mandate. So that rally is already progressing in my view, because if I just wind back 6 months ago or something like around that time, there was some uncertainty about mandate being a little weaker and all, but that was, I think, now behind us, and people are quite confident that there's going to be a clear mandate and political reforms are going to continue. So I think we are already in that kind of, that's why the market, I think, is hitting all-time highs currently as we speak. So that's already playing out. So I don't think there's any huge surprise on that front. Surprise in the sense that that hasn't played out. that the market is taking cognizance of a clear picture. So that's already underway as we speak. What can surprise is basically that it's not as clear as it was thought to be when it actually comes out. That could be what you should say, risk. But as of now, there is nothing to suggest that that's going to happen. So, I think there could be some excitement post-election if that really comes through. But then after that, that will no longer be a trigger. Maybe. So after that, it's got to be what the final budget will be, and what is talked about in terms of development plan and overall spending and how revenues are picking up. All those fundamentals will take over beyond this.
Okay, so you're saying we're already in a pre-election rally. That's what's leading to this excitement.
Yes.
And broadly, we say, okay, because policy continuity, etc. But if I were to ask you specifically, why, as an investor, someone who tracks the market, you think that this will be good for the Indian economy and for investments? Where do you see policy continuity actually make an impact in terms of valuations improving?
Yeah. So if you look at the interim, which I thought was just, it should ideally be just a statement, nothing more. But it unveiled one of the, which I think is undermined. People are not talking much about it, but I think it is very important to note that the interim budget talked about what is called as adding the Anusandhan innovation as the term into the overall development plan of India long term, which is extremely positive in my view, because when I look at global economies where spend on innovation R&D, global R&D spend is more than 2%, or China, we were at similar position in China at the start of the century at 0.7% GDP. We have just maintained it around GDP at currently 0.7. But there was a lot of emphasis in the interim budget, mission statement laid out in a corpus of 1 trillion rupees for zero interest rate loans towards R&D spend. I think this is extremely positive in my view. It's going to improve productivity in the economy going forward, and it is timed so well because what we have seen historically is that R&D spend anyways increases when the capex cycle picks up in the economy, which we have seen in the past also. So we are seeing this capex cycle pick up in the economy, private investments happening, and if there is a policy measure towards really pushing R&D spend, that's going to enhance productivity in the economy. And that's going to be very structural in my view from a long-term perspective. I'm very positive about that.
Let me come to the PSU rally. And, you have largely been bullish on PSU companies. Now, we tend to bracket it in one basket. But the fact is that there are many, many different kinds of businesses. You have PSUs in the energy space, in railways, banks, etc. Do you think that the overall change in sentiment after, I think, decades, that PSU companies can also be profitable, they can also bring value, will sustain, A, and which of these baskets really look like they will have more to give?
So this PSU versus private thing is more to do with where the demand in the economy and cycles are playing out. See, if all this positivity about PSUs would never have happened if the PSUs would not have delivered on growth, their order books rising and the profits rising. And we have seen this story play out. Only thing is people have forgotten completely that between 2003, 2008, where the section of the economy was that the investment rate, capex cycle, and the companies which grow by balance sheet expansion, they were the darlings of the market. So when the capex cycle expands, you have balance sheet driven companies really do well because demand for capital intensive sectors rises. And PSUs are typically in these spaces, and they did really well because the profit, the growth, the balance sheet expansion, everything was expanding. And they did really well during that time. Post 2012, till about 21 pre-COVID, there was this phase of, that the investment rate, the overall real estate cycle, everything fell, and the capex cycle fell, corporate capex fell, and so that's the time when these companies just did not pick up. But I mean, apart from the cycle, we have also seen that the emphasis, the focus of the government towards defense spending, defense indigenous manufacturing in India, these are the new initiatives and policy measures which have also helped the overall manufacturing capex theme, which is helping these companies anyways. So I think this is a phase of as long as the capex cycle continues, in my view, such balance sheet driven companies, be it PSUs or private, will continue to do well. The gap between PSUs and private will always remain, in my view, in terms of valuations, because of the perception that the investors typically have. And these perceptions don't change, and they didn't change even in the earlier cycle. But what matters is growth coming in this sector or not. So it's clearly coming. We're seeing order book of these companies really pick up. Yeah.
Okay, so growth is coming. The PSU and private sort of perception lag will continue. But as we round up this conversation, Vinod, and I ask you to look forward, what are the sectors and spaces that you're seeing with the biggest pop coming ahead, at least in the next 6 to 12 months?
So there are two things to answer this. One is there will be continued momentum in some of the sectors, so where the growth will be good, but there will also be some, for example, banks, they're getting, some kind of re-rating is happening, So the combination of these two, I think, will be where I would bet my money, is basically where their valuations are getting re-rated. People are recognizing that the valuations are cheap and the fundamentals are improving. So as I talked about financials and large banks. And on the momentum side, in the sense where growth, not momentum and stock momentum, I'm talking about growth momentum, where order book is improving and all. And demand is robust. I think mix of industrials, the capex cycle companies, and some of the discretionary consumption categories like premium products, autos, and things like that. I think that these are two spaces I'll be bullish on. Three spaces rather: financials, large financials, banks, industrial capex-driven companies, and pockets of discretionary consumption.
Discretionary consumption is the buzzword indeed. Thank you so much, Vinod, for speaking with us. Vinod Karki of ICICI Securities there on how he sees markets panning out.